Now, the trading strategy of hiding behind the elephant makes a lot more sense to you. It's quite a unique trade strategy, but do bear in mind, obviously, it is a bit more of a scalp type trade opportunity with very good risk-reward metrics. Now, again, we're going to go through the template of it. Again, there's no right and wrong answer. Just a couple of answers and a couple of things I want to point out with you. Now, do bear in mind, obviously, you're going to see that as we go through all of these units, my answers are quite concise. You know, I try to keep things very concise and very to the point in these templates. And, you know, in the beginning, obviously, I want you to be as expansive as possible in terms of your understanding whilst you complete these templates. But over time, you're going to start to learn to quickly not just complete these templates, but also process what the information means. Now, we're going to start off again with a strategy observation. First and foremost, in terms of market context, you know, is this best found in trending or consolidation markets? Now, note I said obviously in trending conditions, be cautious. Okay, simply because when we do find an elephant in trending conditions, it can very quickly extend beyond that elephant. So we said we'd ideally like to see this more in a consolidation type phase, as is a much higher probability. Now, do note, avoid this strategy in times of OPEX or roll, simply because the price action and the liquidity being provided can be relatively misleading. Now, note in terms of balanced or imbalanced markets, we said we can find it in both, but the most important aspect to remember about the strategy is someone sitting there providing liquidity. The market extends beyond that point. Once it gets back above that starting point of providing liquidity, we see an extension in the opposite direction. It is that simple, and that's the key premise of this trade strategy. Now, in terms of trade location, ideally, we do tend to see this mostly at extremes. Why? Because this is a more obvious location for someone to step in and respond to higher or lower prices and ultimately provide that desired liquidity or be that elephant in the market. Okay, now in terms of market conditioning, some of the time frame participants you can expect to see, well, they are going to be large. Okay, to provide that kind of liquidity, you do need to be a relatively influential, large participant. Ultimately, they are initially providing liquidity before taking it. So that sort of size can only really be a large time frame participant. Now, note in terms of liquidity, this is the key proponent of the strategy. This is what, you know, fundamentally underlines this trade strategy. So the tip, don't forget, was what is high relative volume. That's the key. You know, you can obviously learn to see what an iceberg or an elephant looks like, but it needs to be relatively high. And do note, when we obviously saw that relatively high volume that failed, do note that it can, you know, obviously, you know, you need to learn to differentiate between what's a good elephant and what's not a good elephant. All right, obviously volatility. Note, it's relatively subdued strategy in terms of volatility, as it is obviously more of a scalp type trade opportunity. Okay, let's now move on to the identification of the trade.